Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Mr. Michael Becker, but Michael is on another due diligence assignment, and we wish him the best. So sitting in today is James Eng with Old Capital. James, how are you?
Great. Thanks for having me, Paul.
So what's going on in the Old Capital world these days, James?
A couple things. Next week, we are going to have two events, actually, a webinar. So Multifamily Financing 202 on Wednesday, June 20th. And then that's going to be talking about sort of what's in the Fannie Mae box and what's outside of the Fannie Mae box. So register for that at oldcapitalpodcast.com. And then I think you're going out to California.
I'm going out June 21st to Northern California to be with Brad Sumrock and JC Castillo up in Northern California at the Apartment Investor Network at the DoubleTree Hotel. If you want to register for that, there are just a few tickets remaining. I think we have 150 to 200 people that are going to be up there with that. You know, we always go up to California every once in a while because a lot of investors live up in Northern California. But this is a great opportunity for investors in Northern California to kind of understand a little bit about what the big attraction is to investing in outside of California, in Texas specifically. So we're going to have three investors that live up in the Silicon Valley area. And they're going to kind of explain how they or why they and could you invest in multifamily properties in Texas. So it's a good meet and greet, good networking opportunity, and some great people that you're going to be able to say hello to. But I want to get back one last thing about what James said, the Multifamily Financing 202 that James is going to have. I can't stress how important that is to watch that and understand it. There's going to be hundreds of people on that webinar. James had one last month. Hopefully you had seen that. And I think we're going to have 500 plus people in that webinar, James?
Yeah, so about 400 people have registered for the 202 one. And so, yeah, definitely check that out. But then also one more event on the list, slightly bigger venue than San Jose, but AT&T Stadium on September 13th. We're going to have our annual conference. So if you haven't registered for that, that would be on the website as well. So that one's day one is really at AT&T Stadium, bigger event. And then on Friday, we're going to have a couple of bonus sessions. So go and meet the listing brokers and then also a session on raising equity. So
fantastic. Go onto the Old Capital Podcast website and register for both events. So we appreciate that. Today in the podcast, we have some friends of ours. We've known these folks, at least I've known one of these folks for a long period of time. In fact, we used to work together back about 20 some years ago. I come out of the banks and she comes out of the banks. And I'm still in the banks and she's the smart one because she's gone from being a loaner of stuff to being an owner. So being in the podcast for the second time, and we're going to play a catch-up today, kind of see how they've done. Last time we had you in was March of 2016. Can you believe it's been over 2 years ago?
Seems like a blink ago.
Yep, goes fast.
Blink ago. It was episode 33. If you want to go back, I want you to say hello and meet, if you haven't, Bonnie and Kerry Staples. Hey, guys, how are you?
Hi, guys. Great.
Thanks for coming in.
Thanks for having us.
We appreciate that. I'm going to kick it over to James, and let's get going.
So we had you on the podcast last time, and you had just closed on a 106-unit deal. And since then, you have bought 3 other deals in DFW and sold that 106-unit deal. So maybe before we get into that, let's talk about sort of how you guys decided to get started in multifamily, and we'll get into those transactions.
We actually originally started in single family and thought that was the avenue to go to accumulate a lot of single family and then sell them all one day and then take that money and buy multifamily. And that, of course, wasn't going as quickly as we thought that it should because the single family arena is lots of competition there, So we actually then learned a little bit about multifamily, went to a conference on multifamily. And actually, we were part of a group that taught about multifamily. And so we thought, well, why couldn't we do this, And so continued our learning and really got a hold of a group that didn't teach that you had to have single family experience first, that you could just jump into multifamily. And we grabbed a hold of the training and took the tools and dove in, and it's been a great adventure. So we're glad we did that.
So in March of 16, after you bought that first deal, were both of you working full-time? Did you have normal jobs, 9-to-5 jobs, or was that sort of full-time multifamily investors at that point?
No, we both had full-time jobs. Bonnie was working at Merrill Lynch at that time, and I was at IBM. So we were both doing this while working full-time jobs.
Okay. And so in the last couple years, is there anything what made that ability to go full-time in the multifamily? Like, how many deals did you feel you needed under your belt before you felt comfortable leaving your daytime job?
Yeah, so we sort of took a big picture look at what we were doing with our financial situation. And although I would take a big dip in my pay by leaving full-time job, we felt like taking a step back would actually help us launch us a little bit quicker. So I actually, after lots of counsel with Kerry was ready for me to quit, and he's like, "You can do this." And I actually loved my job at Merrill Lynch. I worked for great people, loved what I did, loved our clients. But also, as you hear, you're building someone else's dream. We knew that that's what was happening, and realized that, to take this to the next step further for our family, that it was time for us to adventure off. And so I did quit. Once my boss actually announced that he was going to retire, I said, "Oh, okay, this is a good time for me to say I'm going to retire as well." So I actually gave them a month's notice and quit so that I could full-time concentrate my efforts on multifamily. So that's what we did there, and it's actually paid off very well. So.
Yeah, I mean, it was a little bit of twofold. One was that to have more time focusing on the deals, and it also allowed us to free up her 401k money that we then shifted over to invest in multifamily as well. So it allowed us to have access to that in a self-directed manner.
Okay. So let's jump into, so we interviewed you. You had just closed on the 106 unit deal. So maybe, in the last 2 years, maybe give us an update on what you guys did to that deal, and then how was the process of selling that deal?
So that deal was a 106 unit. Casa Flores, we bought that under the name of Casa Flores, and we actually rebranded it. And I always tell this story. Casa Flores means house of flowers, and it had lots of beautiful trees, but it had no flowers, and it was never going to have any flowers because there's just lots of dirt there. So we rebranded it to Los Robles, which is the strong oaks, which was, ideal for that property. And then we came in and just what we like to do to our properties, part of our business model is to come in and love on the property and love on the tenants. And so we, added a better playground for the children. We added grills and community gathering areas like picnic tables for the tenants, because before they would just sit out on the curb because they had no place to gather. And so we did that, and then created events for the tenants as well, family events like Mother's Day and 4th of July, and did back to school drives, Christmas and Thanksgiving. So just loved on the tenants. And then at the same time, we were loving on the property as well, and just made that a nice pop. It was a property that was in great condition or good condition, but we came in and added a little pizzazz to it and a little curb appeal that really made it attractive to people. And as we were going through that process, of course, the market was also helping because the market was going up at the same time. And of course, we were able to increase the rents, and the tenants are loving the place, so they're accepting the rental bumps, and then they're asking their friends to come over and their families. So we had families of families living at the place, and so it just really it all worked together. Every good thing that you did worked to something else good. And as we're going through a property process, we're continually monitoring where it is on our business plan. We've got a 5-year plan, and where is it falling? And, within, less than 18 months, we had already hit our projections and we're our 5-year plan. And as a matter of fact, I called James for some counsel on that. I said, "Is it time for us to sell? It looks like it's time for us to sell." We had completed our plan, so. With James's counsel and our mentors' counsel and some other counsel, we decided that was the right thing to do. And for our investors, they were in agreement as well.
What do you think the greatest impact was on the property? Was it a new sign? Was it the interiors that you got kind of changed up a little bit? Was it the swing sets and some of the things for the kids? What do you think gave us the biggest rate of return for our money for the investment into the property?
I think just building that sense of community, quite honestly. When we bought the property, we kept the same staff because he was a California buyer, so he wasn't going to keep him, and we kept his staff, and they were awesome and amazing. They're still with us today on a different property.
No kidding.
Yeah, but just building that community, I feel, in my opinion, I don't know, you may have a different opinion. My opinion is building that community on the property where you build that loyalty. And yes, the sign looked fabulous, and yes, the color pop looked wonderful. But I think bottom line, it came down to that we made it home, and those people like to be home. You know?
Kerry, how about you? What do you think?
Yeah, I agree. I mean, I think that building that community was a big thing, but from actual capital that we injected into the property, I would probably say it was the painting of the property to where it had a real pop for a drive-up appeal. And then none of the interiors really had been upgraded. So as we were implementing those interior upgrades and fixing, some of that, I think that the tenants could really tie us back in. They could tell that we cared about them. And so therefore, increasing those rents, they were able to absorb that much easier because they were happy with what we were doing with the property, and they could tell we cared about them.
Do you remember in that, from when you took over the property to when you sold the property, sort of roughly rents, either absolute dollar or rent per square foot, roughly or maybe percentage increase?
So percentage increase, it was about a 12% increase.
Okay. So bumping rents 12%, and then maybe getting control of the expenses a little bit.
Absolutely. And then also adding other income items. So one of the things that we did, the parking in that area was very restricted. And so for someone to have a reserved parking spot was they loved it. We took a survey before we took a survey, and people were very interested in reserved parking. And the first day we offered it, we sold out on our reserved parking. So that added some great revenue. The other item that we were able to do too is I had discovered they had a CoinMac lease on the property, but there was a stipulation where you could get out of it. And I worked with the previous buyer because it said if it was a detriment to the sale of the property, they could get out of it. And the seller was willing to help us get out of it. And so CoinMac was able to get out of there, and we were able to bring in our own equipment where we actually owned the equipment. So 100% of the proceeds came back to the property.
And what's CoinMac, James?
So an owner might sign a lease with CoinMac, and CoinMac will put in all the equipment, but then they take all the revenue. So
these are washer and
dryers in the laundry rooms, because I think this property was sort of 1960s, so it doesn't have washer and dryer connections yet. And so the laundry room, do you remember how much the laundry room was making per month?
Back when they had it,
or when you,
once we implemented it, we were making about $1,000 a month.
Okay, so $1,000 a month on 100 units. Okay, and so I mean that can be a big impact on the NOI, and then capping that at a 6 or 7% cap rate definitely helps compared to on CoinMac. You probably got zero.
Yes.
Yeah.
And it was on a quarterly basis. They got a small little check.
And because when we first, the one thing on that too is when we first took over the property, when we were touring it, so we would see people loading up their laundry and hauling it off, and I'm like, why are they leaving the property yet? Well, and then when you talk to the tenants, they would tell you the equipment doesn't work very well. So that wasn't. So once we took it over, they started to use it. So then that actually became an amenity to them, as well as increased the revenue for what we were getting on the property. So
okay. No. And then anything that you learned during the sale process that was your first sale? Anything that you learned through that process?
We're constantly learning, consistently learning.
Well, how did it feel to be the prettiest girl at prom that everybody wants to buy your property?
Well, this is sort of a little funny story, and James was right there with me, so he knows what happened. You know, when we actually sold the property, and you have to say it's okay to fund, and so I got the text or the email that says it was okay to fund the deal, and it really, quite honestly, sort of took my breath away. And James called me and said, "How are you doing?" And I started crying. And the thing it is, because you put so much love, it's like your first child, you know, you really loved and cared and nurtured this thing. And now you're sending it off to college, you know. And so that was the one thing I was not expecting, to happen to me. But it was a great experience. I think just working with everybody on the team, you know, from the investors to the staff, the tenants, to Old Capital, to everybody that we worked with, attorneys. It was a very great experience. It's a learning process. So the whole thing is a learning process.
So if somebody put $100,000 into that deal, what did you return to them in total, roughly?
So our investors received 189% total return in 19 months.
Okay. So if I put 100, they got 189 back in 18 months.
Plus their 100.
189 plus the 100? Or is it 189 total? 189 total, probably.
No.
Oh, 189 on top of the 100.
On top of their,
Okay.
yeah.
All right.
yeah,
Wow.
yeah.
So we don't see a lot of those deals in
No.
today's market.
Don't
so
expect that again either.
Yeah, yeah. Past performance doesn't guarantee future.
So that is a key phrase. Past performance does not indicate future returns.
That's right.
But I will tell you that was a great success.
Absolutely.
And setting the platform for great success kind of transitions you into deal number 2, where you're out with your hat in your hand looking for money, and people are saying, "Can you do that again?" So let's kind of go back, James, to the story.
So the second property that you guys purchased, Villa del Sol. So tell me a little bit about that property and what you guys like about that property.
So that property, we had been watching it for a while. It had been on the market for a while, and I'd been working with the broker, and they went under contract. So we, went off, and the next thing I knew, it was back on the market. The property just had a lot of potential, and also our property management company also believed that as well. So he said, when they say, "Hey, we can turn this into a Los Robles," and so you have a lot of trust. We have a lot of trust in our property management company as well. And so when he said that, of course, when it came back onto the market, we went for it. And fortunately, the brokers at that time, then they knew that we could purchase a property because we had proven that we could purchase a property, and were very open to working with us. And so that ended up being a great deal too.
So what have you guys done? So that closed, I think, February 2017. What have you guys done so far on that property, and what change has that made sort of on the income side for that deal?
Yeah, so this property, again, it looks completely different from when we took it over. Again, it was a property that was pretty drab, and we came in and added a pop of color. Did some heavy lifting on this property, as we had to do some foundation, but again, we knew that going into it, so we just built that into our pro forma. We built that into our rehab budget, that we would have to take care of some major items that had to be taken care of. So, of course, we took care of those items first, and then came in and started adding the pop of color and things to make it nicer, the amenities with the grills and the picnic tables, and updating the model, because the model looked horrible. Updated the model in the office, and then also because we had sold our first property, we were actually able to bring our staff from the first property over, which again has just been a home run for us because they're doing a great job. So.
Yeah, and this one was in South Dallas, so we had a little bit tougher tenant base on there. So, doing a little bit of turn on the tenant base back to what we learned from the first property, which is, create that community so that you get tenants that like each other, that watch out for each other. You end up with a much safer community, and that's typically what people really want, right? Just a place they can afford, that they feel safe, that is a nice community for them to go out and enjoy, and that's what we try to produce, and that's what we just implemented that same process over on this property as well.
So that second deal, we'll skip over the third one for now, but the second deal almost led to the fourth deal that you guys
Correct.
did. And so a lot of times people, especially listing brokers, if they know that you already own in that submarket, they will approach you about other deals before a deal is even on market, or even if it is on market, they will favor you to buy that deal because it might make more sense. So tell us about the fourth deal you guys bought.
Yeah, so we received a phone call from the listing broker on the fourth deal and said, I really want you to look at this property because it's just less than 2 miles away from our second deal. And I flat out told him I wasn't interested in looking because we had just closed our third deal, and we sort of like to wait a little bit and get our
bearings a little bit and
yeah,
get things
solid
rolling.
and he's like, okay. And so then about a couple days later, he called me again. He said, Bonnie, I really think you need to look at this property. Just go and look at it and let me know what you think. So Kerry and I thought, okay, we'll go and look at it. And we went to look at it. And that property, actually, the current owners had invested a lot of CapEx into the property, and it looked really, really nice. So they'd done most of the heavy lifting on that property. So I had to, actually he was there with us, so I told the broker, I said, you're right, I needed to come and see this property. So really glad we did that because it, led to the number fourth closing. So
in that deal, I think, when was that property built? Was it in late 60s?
Late 60s, like 68.
60s as well. And so, a lot of times the engineer will go out there from the lender and they'll have a decent sized list of immediate repairs. I think on that property there was like maybe 2 items, and it was like GFCIs.
That's right.
And that was it.
Yeah.
And so 10,000 of immediate repairs for a pretty good size 160 unit property. And so that really spoke to the amount of CapEx that previous owner had already put in.
Absolutely.
And so what did you guys plan for that property, since someone has already done a lot of the big CapEx items?
Yeah, well, are going to redo the laundry area as well, just because that also, we got the green program on that. So we had to we're putting the efficient water saving items on there. So that's one of the things that we're doing. But again, coming in there, adding the amenities, they had absolutely no playground for the children. They had a big cement tube that the kids played on. And so now they have a big playground out there. And then, of course, the grills and picnic tables. The property looks in great condition. They do actually have a great big area that's connected to the office that actually has some room to build some efficiencies as well. So that's in our plan as well, is to try to build that out. And then again, just build the community. We are actually going to add gates across the front of it as well. And so this just sort of keeps the traffic from walking on the property when they don't really live there. And again, just showing the tenants that we love and care about them, and continuing with that, yeah.
The one thing I know were your first 2 properties, was it all bills paid, or did you rub back water and electric, or is it all bills paid on most of your properties?
So most of them are all bills paid, actually. Okay. We do charge back some on the water and on trash.
Okay.
So, yeah.
Okay. And have you guys looked at the difference between, because a lot of people, a listing broker sometimes will try to sell that it's all bills paid now, but you can start rubbing back electric and water and trash and pest control. Is that harder to do than, or does it depend on the tenant base and what they're used to? Yeah,
I think it depends a lot on the tenant base and the surrounding area as well. Our tenant base on most of our properties, they like the consistent bill. Okay. They know what they're going to have to pay every month. They don't like the fluctuating of, their water bill or electric bill being one amount one month and a different amount the next month. So we really have not considered changing those at this time. So.
Well, other than maybe the Duncanville property that we have, that one currently is the only all bills paid in the submarket there. Okay. So that one we're not currently it's an all bills paid, but we will evaluate doing rubs on it at some time in the future for sure.
Okay. And then so both of those, so you closed Fair Meadows in January, and then you just closed Spanish Timbers in May. How was the capital raising for doing 2 deals in less than 6 months? Any challenges in that time frame? I
think that it went fairly well, quite honestly.
Yeah, of course, we've built a database. We've talked to people over the 4 years that we've done this. So, we have a fairly good-sized database. So the raise in that quicker turnaround, it was a little nerve-wracking, obviously, right? It always is when you're raising, a pretty good chunk of money. But it went fairly smooth. It maybe took us a little bit longer, but nothing to really say was a big deal to raise the money on that second deal, because it was still a good 3 months or so after the first deal that on Bella Vita that we did.
So a lot of people, let's say their first deal is $5 million, they have to raise $1 million. Any tips for, now that you've done it 4 times, any tips for those people who are raising money on their first or second deal that maybe you've learned in the last couple capital raises?
Yeah. So first of all, I'd like to say that I think that your capital raise starts way back when. And so when Kerry and I first started looking at multifamily, although we always knew that our end goal was to be lead sponsors, we actually started as passive investors first. And so, being a passive investor, we were able to gain a lot of knowledge and processes by example of how other people did things. So we actually, before we even ever did our first deal, we were in 7 other passive items first. So I think that that's real critical because you learn from each lead investor different ways and different nuggets of what you want to implement into your own business plan. So I think that was very, very helpful for us.
Thinking back, what type of things did you learn that you did not know? So, you come from a financial background, you come from, you owned your own house, but this was your first investment into multifamily, into somebody else's multifamily. But what do you think you learned from the other people that were deal sponsors, the people that were the captain of the airplane? You were maybe a limited partner on 7 other transactions. And again, how many units do you think total were there that you were invested in?
With the 7 deals?
Yeah.
I don't know, maybe 1,500 doors total.
Okay, so that's a pretty good size.
Yeah.
Some people, say 7 deals, maybe it's 25 doors or something like
Yeah.
that. But 1,500 doors is a pretty good size portfolio. So you guys have learned. So give me specifics if you can. Again, thinking back, what are some of the things that you learned that you did not know, doing single families type of stuff?
I learned primarily the processes, of the emails that go out, how you keep track of who might be interested in working with you, and the timing of the information that you send out to your potential investors, your monthly reports that you send out to your investors, your communications back to your investors, which I think is very, very important.
Yeah, the thing that I would say is just the, how they explain the numbers, how they went through and explained the spreadsheet, how their projections, how they got to the projections and all that, because that makes a big difference on how good the deal is. And as a passive, you still want to make sure you understand all those. So I took those lessons that how maybe they explain that and how they kind of position that to us as we're investing.
Yeah, those were critical lessons for
Absolutely.
you guys, because you really had no experience. Now you jump in and you're in 7 transactions, seven groups had to explain how these deals worked, what the positives were, what were the negatives were. You kind of understood who they used for vendors in your area,
Absolutely.
who they used for management companies. So you kind of saw that, who they used for management software. You saw how they gave your information back after you had funded the deal, and now you're expecting to get a rate of return on your money. If it was a yield deal, you kind of understood it was an ACH or was it checks that we're going to get. You had to understand what their write-up was every month or every quarter from the investor. So you learned a great bit. So it probably was a good or easier transition when you went from being a passive investor to being a lead person, a captain of the airplane. So because you learned everything from the platform in the back of the airplane to being able to go and fly your own deal.
Absolutely.
Is that
Yeah,
correct?
Absolutely. And you can learn from the good and the bad, right? So you
Right.
can learn, you can learn either way, you learn how you want to do things or how you don't want to do things as
Yeah.
well. So I think it was
And I would just, because Bonnie's in charge of all the processes, so like she said, she focuses on that. But to your point, Paul, it was critical that once we did it, it made us a lot more efficient on how to accept all the documentation up front, and then how we communicated back to make it was clear communication back to our passives as they're going through that, make sure that they got all the reporting that they needed. So us doing all those passives helped us really create our processes before we ever got our first deal to make us, more efficient, and hopefully passives enjoyed investing with us because of that.
Yeah, I think a lot of people freak out when they think they got to raise $1 million, for the first time out of the box. You guys have given money, $100,000 here, $75,000 here, before you even asked for the first dollar in your own transaction. So was it easier to have a dialogue with the potential investor to invest in your deal by having all this experience?
It was, and I'll just go back to you saying people freaking out about having to. Well, so I always told Kerry that he was in charge of fundraising.
I'll find the properties. Kerry, you raise the money. You got the easy part. I got the tough part.
That's right. So with our first deal, when we got Casa Flores, he really was a nervous wreck, thinking, "Oh my goodness." And then, fortunately, as we said, we had built that platform and we'd built our database, went to lots of networking, we're involved in a group that actually everybody has the same educational background as far as somewhat of multifamily at least. So some of that you're not having to explain every little detail because they're already have quite a bit of education in that area. So when we did send out our first indication of interest on Casa Flores, again, Kerry was like really afraid. And fortunately, it went really, really well. It was so.
Well, the money raising never goes as quickly as you want. I mean, until you have it all, right? But yeah, I mean, being that we're part of the Brad Summerock group, it has been, everyone's like-minded. They're already trained. They're already educated. Not that, we raise, 100% from there, but a big chunk of it. So it makes it much simpler for us to syndicate the deals and raise the monies for sure.
So now that both of you have gone pretty much full-time into this, what is sort of your day-to-day look like now that you have 4 deals or 3 deals? How many deals do you have? 3 deals?
3 active deals.
3 active deals, and then looking for new deals. How do you guys sort of split up your roles and then focus on now?
Yeah, so my role is to acquire more properties. So I spend time analyzing deals, crunching the numbers on deals, reaching out to brokers and seeing what they have and building those relationships. So that's and then finishing out the construction, the rehab, all that we have to get done on the 2 current properties we have. That's my role. And then of course Bonnie helps out in some of those areas as well because any type of design or that type of stuff, obviously she has input on how we want to make things look, and then she's in charge of all the processes and back end and all that. And we have pretty good processes, but there's always ways to improve it. So now hopefully we have some time for us to even make those more efficient so that we can spend more time looking at acquiring and increasing our passive database basically.
Yeah. And even although we're leads as well, and we've started with 7 passive deals, we actually are in 29 deals totally now at this point. And only 4 of them were deals that we're leads on. So the other 28 or how many ever that is, 24 are other deals that we are. So we still invest passively as well. So keeping track of that is a job as well.
So that's a lot.
Yeah.
And so let's tell the good news and the bad news. Out of the 27, 28, or 29 transactions you're in, are all performing?
We have some that are new, of course, so those aren't performing yet. We have one that was hit by a hurricane. So that one's, trying to come back.
Yep.
And just to be quite honest, our properties are doing the best of all the ones that we own.
Yeah.
That you're invested in.
that we're investing in.
Okay.
Yeah.
So you guys have, obviously a vested interest in your properties that you're focused on. Is there anything, what do you think, for general partners out there right now, what's sort of your biggest challenge in today's market?
In finding deals?
Finding
it's
deals,
it really is. To me, it's just finding a deal where the cash on cash works. That tends to be what I'm more focused on, is the cash on cash, just because that's more controllable. The cap rate is very compressed right now, so the reversion cap rate, we'll see what happens with it in the future. So that's more of a bigger projection. So I tend to try to focus more on the cash on cash, on what we can do to find a deal that fits into our model, which we used to be double digit. Now, if we can get somewhere 8 to 10, we're doing good. So we're looking for deals that fall into that criteria. So it's really just finding a deal that kind of works for us, because some of these sellers are pretty steep on what they want, but if they're getting it, hey, good for them.
And then when you're talking to investors on these last 2 deals, what was sort of were they looking total return, or if they're looking cash on cash, were they looking for sort of high single digits on cash on cash?
Yeah, they were fine with high single digits. It just depends on the investor, really. Most are looking for cash on cash, but there are some that they still focus on the total return. So it is a little bit of both on your investors. It just depends on what your investor is more focused on, but it's usually a mix between the group.
And then we always like asking this question towards the end of the interview is, if you had one thing to tell a new apartment investor, what advice would you give to them?
Well, me and Bonnie were talking about this one on the way over, and you know, one thing is that don't just take the OM as gospel that that's all true, because we've had deals where we've
Offering memorandum.
the offering memorandum that we've got, and we went through and ran the numbers and everything looked good, and then we thought we were gonna have this deal done, and then we started asking questions about things that were in the OM, and they were like, no, we're not doing that. Like, for instance, one said they were going to put new roofs on the whole entire complex. We asked because that was in the OM. Then we asked, and they said, no, we're not putting that in there. So we're like, okay. So I would just say confirm. Don't just assume that what's in there is actually, go ahead and ask the question to confirm that, because that has bit us on one deal for sure that was not the case. So.
Yeah. And the other thing I just say, if you're a passive investor, definitely do your due diligence on the lead and also their property management company, because those are two key people that are actually in charge of your investment. And just be real. I think those are just two critical points. Just be aware of who you're investing with and who they are, who the property management company is.
And if people wanted to learn more about sort of the projects that you're working on, what is the best way for them to reach out to you guys?
Probably the best way is to reach out on my email, which is Bonnie, Bonnie, Staples, Staples, .mf@gmail.com. And that's the best way to reach out to me. Kerry has an email as well, but I actually do all the investor relations.
Then we have a website as well. If you want to go to that, staplesmultifamily.com, you could go to that as well if you want.
That's great. You guys have a huge amount of excitement out there, and you do give a lot back. And maybe one of the things that I would suggest people to do, maybe like what you do, is you guys organize a meetup. And tell us a little bit about how you got into that, and before we end the interview here, but how has that benefited you? And tell us what you do and what you explain in your meetups.
Right. So we have a meetup, and we actually just sort of really explain, it's different topics every time, but just sort of explaining really how simple it really can be, taking something that can seem so complex and break it down, make it a little easier for everybody. But we also have a lot to give back to our mentor, which, taught us what we are doing, and that is Brad Sumrock. So we do invite people to attend Brad Sumrock's Rat Race to Retirement. They call it R to R. He has that 3 times a year. Actually, he has one coming up July 21st and 22nd. It's a 2-day event. And we quite honestly learned so much from his 2-day event, more than we had ever learned in any of our other studies in multifamily. And we had done other studies before and had belonged to other groups before. So definitely get a good mentor to teach you what you need to know so that you don't make the mistakes, that others have made.
Yeah, in the meetup that these guys hold, they may have 25 or 50 people in the meetup, so it's a large meetup that they do on a monthly, quarterly basis, and it's always fun to see all the networking that goes on, because a lot of people who are interested in multifamily, they think a lot of these apartment buildings are owned by institutional people. I mean, they just don't know. People just don't know. But when you kind of explain it down to the kind of the bottom shelf level of how these deals are done with other individuals, whether it's you by yourself buying the property if you're a high net worth individual, or it's us as a group, as a syndication buying these properties, that we can all participate in these deals. And networking, as James and Michael Becker says, people are not going to come to your door. You got to go out and meet people. And I think networking through meetups is a great way of kind of building your team or finding other people that have similar interests of what you're doing.
Absolutely. Yeah. And also, like when Kerry and I first started looking at multifamily before we belonged to a group, we thought, okay, multifamily was a 4-plex, and sometimes when we have people that come to these meetups, they think, okay, they're aspiring to have a 4-plex or a 6-plex, and after we are able to speak to them a little bit, quite honestly, the bigger they are, they're actually easier to manage, because number one, you can put third-party management on it, and also you can syndicate the deal where you can actually not put all the funds in yourself, where you have a group of people that you all work together and actually do group purchasing. So it makes it a little bit easier.
And the loan is better too.
And the loan is much better.
Right.
Yes.
So Bonnie and Kerry Staples, thanks for coming in. I mean, you tell a great story about your 106 unit properties that you bought, the Los Robles, that had a great return on it. So you did a great job. 255 units, that Villa del Sol. And now it's called, I guess, Bella Vita. Fair Meadows had 200 doors, 160 doors with Spanish timbers. Unbelievable, a lot bigger than the duplexes and fourplexes. So you've done a great job. James, anything to add before we say
I
goodbye?
think that's it. I mean, do you guys have anything else that we missed or that you want to share with the group? We have a couple thousand people at least listening. So anything you guys like to end the note?
Just if you want to, reach out to us, like Bonnie said, she gave her email address, or you can go to, again, our website at staplesmultifamily.com, or, we'd love to see you at our meetup that we do over in the Garland area. Because we do, like they said here, we cover the good solid basics, and it's a great networking event. So we'd love to see you out there at that.
Yeah, going to these meetups, and especially your meetup, it's like putting your big toe in the water and kind of figure out if this is something you want to get into. And you guys can kind of explain kind of in a video PowerPoint presentation about how you guys did it and how somebody else can do it. So there's no ties to do business with you guys, but
Absolutely.
it's something for people to learn and understand and just put their first toe in the water and kind of figure out this is something that they want to do. So,
Well, and I want to add one thing to that, Paul, is that, we love to give back. So a lot of people ask, why are we teaching people? It's because, we don't have the time or the money to go buy every deal,
Yeah.
right? So we love to give back and teach people on what we're doing and how we're doing it to make them successful. So we love to see people we've taught that went through a meetup, joined the group, whatever, and then is out successful. That's very enjoyable for us to see that as well.
that's great.
Absolutely.
You're good stewards. So of multifamily, we appreciate Bonnie and Kerry Staples coming to the podcast.
Thank you, guys.
James, always a pleasure.
Thanks, Paul.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.